And on this, we see that one important element that must always tend to click at the back of our mind is that banks ideally are treated just like any other company, only that I'll be having some special activities relating to the banks. And as so, you'll also find that it is the trick will always be for us to be able to identify the balance sheet items and non-balance sheet items, which will fall, of course, to maybe income statement and SFP. So today's is a continuation of that, and I want us to focus mainly on one key element that we will be referring to it as taxation of insurance companies. So I want us to handle taxation of insurance companies. So after this, of course, I know with time that is here, maybe up to around 10 thereabout, you can handle both for general insurance and maybe life insurance, because the concept of insurance is also as simple as what we have looked at under banks. So in that case, you'll find that it will be easy. So looking at that case, we can show off motor. So just a moment here. We have it. Sorry for that. So we're seeing that anytime you're talking about taxation of insurance company, the whole idea is that insurance funds, ideally, insurance firms, they are taxed just like any other business. Yeah, they are taxed just like any other business. That is, of course, we are talking about company, right? Where, on this case, you'll find that we normally tend to consider two types of insurance company. In this category, we normally tend to talk of the first category being general insurance and life insurance business, you see. So that is to say, anytime I'll be talking of course, insurance company, you'll find that for insurance company, I'll be talking of these two items just as Mwalimu was mentioned. We'll be talking, of course, of general insurance, and number two, we'll be talking of life assurance business. So if I told you to look at it in this category, you'll find that we'll be talking of life insurance business, and number two, this is life. And number two, we'll be talking, of course, of general insurance business. General insurance business, where you realize that for general insurance business, this is basically classified into various forms of business that we can indulge ourselves in, which will include, talk about maybe talk about we can talk of vehicle insurance, yeah, talk about fire, talk about theft, talk about terrorism, yeah, talk about cyber attacks. All these are basically form of general insurance business, whereby you'll find that for taxation purposes, this, as much as a company has, as much as maybe assuming this insurance company has these two forms of business, for tax purposes, they are going to be treated separate. For tax purposes, these two forms of business are treated separate. For tax purposes, these two forms of business are treated separate. And in that case, I'll want us to start with general. I'll want us to start with general insurance business. I'll want us to start with the general insurance business. You say that for tax purposes, you'll find that the two will be treated separate, but at this point you're saying, I want us to start with general insurance business so that you can be able to understand it clearly, okay? So on this, of course, we can talk about taxable income. Because remember, we say that tax is always about taxable income, allowable expenses, and taxable income, non-allowable expenses. That is all about tax, by the way. That's always about tax. And on this case, looking at these incomes, looking at these incomes, we'll be talking of number one, gross premiums received. Remember, premiums, ideally, these are the main source of course, income to the insurance. And this premium, of course, we are going to deduct. This is net, talk about gross premium. We net off or we adjust. We are going to adjust that premium. We adjust the following items. You're going to adjust with returned premiums. Talk about returned premiums. We're going to adjust with returned premiums. Yeah. Talk about aspect to do with reinsurance premiums paid. Reinsurance premium paid. etc. So we have our gross premium. We adjust with these items. Number two here, we can of course talk of another important income to consider. Another important income to consider, which we'll be talking of commission ceded. Commission is a commission ceded. Commission ceded is like accepted, not accepted, but received. Commission ceded slash received. Okay. Or receivable. I'll be explaining to you the concept of ceded. I'll be explaining to you the concept of ceded. Then, in addition to that, we'll also be talking of number three item here, which in this case, we can talk about claims recovered. Claims recovered. Yeah. We can talk about reduction in provision for unexpired risks. Reduction in provision. Reduction in provision for unexpired risks. We can talk about this is number 4, yeah. 5, we can talk about other allowable expenses, just like any other business. Allowable expenses. Allowable expenses, yeah. Just like any other business. So you'll find that these are the main items to consider for special incomes in insurance. Then these allowable taxable income, not allowable expenses, but taxable income, because you're looking at income. So talk about taxable income. Taxable incomes, just like any other business. Taxable income, just like any other business. Yeah, just like any other business. Rental income, all these other incomes, investment incomes, and the rest. So special incomes for insurance company, you'll find that this is what we'll be having. This is what we'll be having. And by the way, it is not hard. It is as simple as the way it is, like that. So after looking at that component, that of course should take us to another key element, understanding allowable expenses here. Understanding the allowable expenses. Understanding the allowable expenses. So about allowable expenses, exactly the same thing, special expenses relating to insurance. The rest will just be like any other business. Where on this case, number one, let me just take the same number format. We are talking of claims paid for the year. Claims paid. Claims paid for the year. We can talk about commission paid. Commission paid / accepted. Talk about increase in provision for unexpired risks. Talk about urgency expenses. We can talk about management expenses. And these management expenses should be one relating to general business. One relating to general business only, because you're dealing with a general business. Any expense relating to life assurance business, it should be deducted from basically general, because they are supposed to be considered independent. They are supposed to be considered independent. Then after that, that will also take us to basically other allowable expenses, just like any other business. Other allowable expenses, just like any other business. Other allowable expenses. Just like any other business. See, just like any other business. So it is as simple as understanding this, my good students, that at any given point in time, whenever we're talking about insurance, first of all, we agree that this is to be treated or to be considered like any other business. So in this case, you can see I'm having some special expenses that we are listing here. We're having some special expenses that we are listing here, as well as the special incomes that we are listing at this point. But ideally, the concept is just the same as any other business. The concept is just the same like any other business. So on this case, maybe to explain some certain terminologies here, like for example, you can see we are talking about commission ceded. Commission, let me just explain this concept. Commission ceded or commission accepted. You'll find that we'll be looking at this concept whereby I'm having, say, CIC insurance here. I'm having, say, like Jubilee insurance here. So these two companies, they conduct the same business, yeah? These two companies, ideally, you'll find that they conduct the same business. They conduct the same business, yeah? They do conduct the same business. So what will happen in this case, you'll find that there are some risks which probably CIC offers and Jubilee doesn't offer. Or there are risks which Jubilee covers and CIC don't cover. So here we're having Rehema as a client. We're having Rehema here as a client. So what Rehema will do, Rehema will approach CIC, yeah? Rehema will approach CAC for a certain cover. Approaching CAC for a certain cover, unfortunately, CAC maybe they don't have such, but they wouldn't wish to turn away the client, right? So what CAC will do, CAC will approach Jubilee, yeah, and agree to give them this client who is Rehema. So what will happen in this context, you'll find that I'm having here, talk about, I'm having CAC here. CAC will go to Jubilee, yeah? CAC will go to Jubilee, approaching Jubilee that we're having client who is Rehema, and in this case, we don't have this cover, but we want to give you this client. So in this case, what will happen? In this case, you'll find that Jubilee will accept the business. Jubilee will accept the business. And accepting this business, you'll find that in this context, they'll want to give or say thank you to basically CIC for giving them a client who is Rehema. So what will happen in this case, you'll find that, therefore, in this context, Jubilee, yeah, Jubilee, talk about, I can remove that. Just pick a simple shape here, yeah. So you'll find that a Jubilee, in this case, will say thank you to CIC. And saying thank you, in this case, they are saying thank you with a commission. So in the books of CIC, they have received a commission. They have received a commission from stealing that business, ceded. See? So in this case, you'll find that in the books of Jubilee, they are accepting that business. So this is commission accepted. You see, commission accepted, meaning that it is an item that they are paying as a result of accepting the business. Whereas CIC, they will be receiving this commission, which you are saying that it is what? Commission ceded or commission received in the books of CIC. So that is the concept of commission ceded, and of course, commission accepted. So on this other end, we are talking of a provision for expired risks. Yeah, I am anticipating that whichever cover that we have, I am going to pay for the same. Meaning that, in other words, it's like I am anticipating, see, expectation of the premiums to be paid. Where in this case, you'll find that I am having, say, like 1 million. But the actual, what I'll be having now as at the end of the period, maybe is 800,000. See? So in this case, we are taking this reduction as an income because in reality, it is like a saving. Yeah? We're having form of a saving in a way. We're having form of a saving in a way. We're having form of a saving in a way. That's why we're saying that reduction in provision for an expired risk, in this case, it is what? An income. But if it is the opposite, where I was anticipating for 800, but we ended up having these risks as 1 million. So you'll find that I'll be paying, or rather the provision will be higher than what I had anticipated. So that, therefore, that's why you're saying that increase in provision for an expired risk is simply what? Is simply an expense. And this is what you're having here. This is what you're having here. This is what you're having here. In addition to that, actually, another item that you can also add here, just remembered, this aspect of a bonus in reduction of premium. Bonus in reduction of premium. That is an income. In a sense that for bonuses, we'll be looking at them in two perspectives. Number one, I can pay cash bonus, or I can basically ask, say, like maybe in this case, maybe Alan was supposed to pay a premium. Maybe Alan was supposed to pay a premium. Alan was supposed to pay, say, a premium of 300,000. But because in this case you're giving bonuses, I'm having an option of telling Alan, you know what? You're not going to pay the 300, but instead you're going to pay 250,000. The other 50, we are going to pay on your behalf, imaginary, right? A bonus that you're giving you. So the account of Alan, it will still read 30 or 300,000, but he has paid 50, whereby in this case, this has been taken as a bonus in reduction of what? Premium. But there are other cases whereby Alan will just pay 300,000, but the company is giving a bonus in cash. A company is giving a bonus in cash of 50,000. So you see, both are bonuses, but the first one is in relation to outlay. I'll be having an expense. I'll be having cash that I'm spending on this case. Whereas here, we are not yet, actually, we're not giving out anything. Only that imaginary, Alan will be like, he has paid to 50, but the 50 has been paid for them, for him by the company. But in reality, this is an imaginary value. So you'll find that at the end of the day, this is a saving compared to if we'll be paying our cash. And that's why bonus in reduction of premium I'll be having here as our taxable income. So that is one main element to understand. Now, so that you guys can understand how this concept is very easy, let us talk about the format of presentation. Format of computing, format of taxable income computation. This is for an insurance company. I know very well that we will agree with Mwalimu that honestly, so long as, and this is what I've always said, so long as you're having the format, you're as good as done with all these items. So long as you're having the format of presentation. That is the only thing that you need to know. That's the only thing that you need to understand here. The format of presentation. If you master the art of understanding the format, me, I'm very sure there's no question that you can't handle. That one I can just tell you for free. There's no question that you can't handle if you're good with the format of presentation. If you're good with the format of presentation, for sure, there's no question that you can't handle. There's no question that you can't handle. There's no question that you can't handle. So looking at this format, you'll find that I will be having the following. So I'll be having maybe take CAC Insurance, CAC Insurance Company, computation, of taxable income, for the year ended 31st December 2023. Yeah. So this should give us a value to be in our currency that you're looking at. So about gross premiums received. This we are going to adjust with all these elements. See these elements. So gross premiums received, having it at that point, we're going to adjust it first of all with premiums at the end, outstanding, premiums, at start of the period, or rather at the end, start with at the end. This one we add. Talk about outstanding premium at start of the period. This one we less. We'll also be having an item of returned premiums or premiums returned. We less. We can talk about aspect to do with insurance premium paid. Insurance premium paid. This one we less. So that as at the end of the day, after adjusting for all this will give us what? Our net premium. Net premium. Be having our net premium here. Okay. So once we have our net premium, we can consider these other incomes that the company will earn, like talk about commission ceded. Talk about commission ceded. We can talk about aspect to do with claims recovered. We can talk about all these other incomes that we mentioned here. Reduction in provision for unexpired risks. Reduction in provision for unexpired risks. We can talk about aspect to do with reduction in provision or that the same as reserved. So we can talk about bonus in reduction of premiums. bonus in reduction of premiums. We can have other incomes like rental income, if at all the company is having. We can talk about maybe interest income. This interest could be from either banks, treasury bills, for example, and any other investment income that you can talk of, so that as at the end of the day, this would give us our income there. Having our gross taxable income. Having our gross taxable income. After that case, that should take us to allowable expenses. Allowable expenses. Looking at allowable expenses, what will you be expected to have here? This is simple. We take everything that we have considered, of course, on top there. Like, for example, at this point, you can start with the claims. Talk about claims. Claims paid. Or claims for the year. In this case, to determine claims for the year, we can take the following. That is, of course, claims paid. Claims paid. We're having our claims paid at this point. We take claims outstanding. Claims outstanding as at the end of the period. We take claims outstanding at start. At start of the period. So once we have this will give us the claims paid for the year. Like talk about commission accepted. I'd explain this concept. Commission accepted. We can talk about all these other expenses now here. See. Increase in provision for unexpired risk, agency expenses, management expenses. Yeah. You can talk about maybe if at all you're having any legal expenses, all of them you can have it here. Legal expenses. Talk about capital allowances. Consider all of these expenses here. So once we have all our expenses, this should give us now, deducting these expenses, this will give us what? Our taxable income. See, that would give us our taxable income. So this is what we should be having here as our taxable income. See? As simple as that. So long as you're having this format, you're just good to go. So long as you're having this format, you're just good to go. And you're going to prove it here. We are going to prove it here as we'll be looking at a question. We are going to prove it here as we'll be looking at a question. So have that format quickly. Have that format, have the format. Have the format. Then you look at a question. You'll agree with Mwalimu that honestly, so long as you're having the format that I've just given you, you're as good as done with this first bit. So we have our question. Let me check. As you're clearing the format. Another question here. August 2023. Two banks. Yeah. So look at this question. This question was attested in August 2022. See this question. August 2022. Question number 4. Where we are given two insurance firms. No, not two, but One insurance firm, of course, general insurance, with the following details here. See? So look at it. In this case, you're told that this is question number 4, August 2022. You can have a look at it quickly. This is what you're told that Riziki Insurance Company Limited was incorporated.
I cannot be able to see.
Yeah?
Mwalimu,
Yes, Alan, you're saying?
I cannot see the question. I cannot see the question.
Just you can't see the question?
Yes.
What about now?
Even now.
Rema, are you able to see the question? Rehema, are you seeing the question?
Halfway. Yes, but half.
Yeah, because that is what I've displayed, right? In this case,
Oh, yeah.
Yeah?
Yes, yes.
Alan? Still not yet?
Not yet. Or I can try.
Oh,
Yes,
now
or I
it's
can
full.
try to.
I'm not sure why you can't view the question.
Or can I leave? Can I?
Yeah,
Can I just leave, or and then I rejoin again?
and then you join, you see if at all you can see the question.
Okay.
Alan, we are waiting for you to confirm if everything is okay now. Alan, is it okay?
Mwalimu,
Now it's okay.
I
Yeah?
think now I can be able to see the question.
Okay. Okay. So these are what you're told. Riziki Insurance Company Limited was incorporated in the year 2019. The company deals with different classes of insurance. The following trial balance was extracted from the book of accounts as at 1st December 21. So what I'm given here are number one, property, plant, and equipment, provision for depreciation, investment in government securities. So these are what you're given. Premiums received from direct clients, premium received from agents, commission or insurance accepted, commission or insurance ceded. So we've seen how we can treat premiums. Accepted, we've said these are liable expenses. Ceded as simply, basically what? Taxable income. So sundry receivables, these are of course receivable bank balance, balance sheet items. Directors' fees, in this case, I'm giving at that point. Reinsurance premiums paid for both motor vehicle and fire, and earned premiums for both motor vehicle and fire as at the beginning. Claims outstanding as at the beginning. Claims paid. Legal cost claim on claims. Sundry expenses on motor vehicle claims. Provision for bad and doubtful debts. Remember the concept of provision. We mentioned that any time you're given provision, all provisions are non-allowable except for provision for specific doubtful debts. So I'm told management expenses, investment income, premiums, return, profit and loss account. Then these are what our good examiner is telling us that number one, claims intimated and outstanding as of that 1st December 2021 amounted to 750 for motor vehicle insurance and 480 for fire insurance. These are just claims outstanding. Yeah. Unearned premiums maintained at 80% and 50% of the net premiums received for motor vehicle and fire insurance respectively. So I need to have or to determine our unearned premium as at the end of the period so that we can decide and see, we compare with what we had as at the beginning to determine if we had basically an increase or a decrease. Unearned premium, remember, it's the same as unexpired risks, provision for unexpired risks. Investment allowances have been agreed with the commissioner at 1.2. So that's the capital allowance for the year ended at 1st December 2021. Investment income analysis was provided as follows, where I'm told that we had interest received from government securities. Net, we need to convert it to gross. Interest received from local banks, we need to have it to gross. Remember the concept of qualifying and qualifying interest, that one Mwalimu guided us. Dividends received from a Uganda company. Any investment income received from abroad. Remember what we said? Dividends received from a local company. Remember the dividends we said they are going to be taken as qualifying dividends. Subjected to the ruling tax rate at the 5%, which is what? Final tax. Fees paid to investment managers amounted to 750,000 for the year ended at 1st December 2021. Required taxable income or loss for Riziki Insurance Company for the ended at 1st December, and we are supposed to compute the tax payable if any. Very simple. Very, very, very simple. Exactly what we have seen and whatever that you're looking at is the same thing that we're going to work out here. So having that, we can have the question now. Let me have it in Excel so that you can work it out quickly. As at the end of the day, you realize that these concepts, they are always the same, all. So long as you are able to identify the format of presentation, so long as you're able to identify the format of presentation, all these questions are always the same. Mm-hmm. Mm-hmm. So this is our question, yeah. So you realize that all that we need is basically this format of ours. That is all that we need. So I'm giving you like, I want you to attempt this question using the format. Or let me do this question, then I'm going to give you another one so that you can be quick. So in this case, we start with the title is always very important. I'll just take this. That 1st December 2021. Where we are given Riziki. I'll do for one, then you'll do for the other one because you're having two farms, you're having two business, you're having motor vehicle business. Motor vehicle. We're having the other one is fire. Business, then you can have total. Yeah. So you said you start with premiums. My figures here, shillings. Both in shillings. So we are given our premiums. Gross premiums. $3 million. Gross premiums, you're given direct clients. Direct. $3 million. $2.5. Total. Indirect. This is from agents. $2 million, 1.2. We adjust with any item that will affect our premiums, like number one, unearned premiums. Talk about these are, of course, these are unearned premiums. Talk about aspect of unearned premiums. Remember, we're having them there, return premiums, insurance premiums paid. So we're having any other item, premiums returned. So about unearned premiums at start of the period. Unearned premiums. Unearned premiums and claims. Actually, sorry, unearned premiums, remember Molimo was mentioned that these are like provision, yeah? Expired, unexpired risks, unexpired risks, unexpired risks, unexpired risks. So you'll have to determine an increase or a decrease on the same. I'm having reinsurance premium paid here. Reinsurance premiums paid. For motor vehicle, 1.4. Not 1.4, but 400. The other one is 150. Talk about claims, legal, sundry, provision management, premiums returned. Premiums returned here. Premiums returned. Premiums returned. You're given how much for premiums returned? 800 and 700. 800 and 700. So just following the format the way it is. Investment, management. We don't have anything that will affect our premiums up to that point. So talk about our net premiums here. So the total net premiums We are having another item here, which of course now are our incomes. Number one, we start with investment in government securities. And in that case, whatever that we're going to earn, remember this is an investment. This is not this is a balance sheet item, right? Whatever that we're supposed to take, it is what interest that we're going to earn. So in this case, we are having gross premiums, we've dealt with that. Sundry bank directors fees, that is general. Insurance premium, we want to look specifically for what? Specifically for the business that we are having here, first of all. Insurance premium and earned premiums. So let us consider our incomes. We're having investment income, right? Consider investment income. That is now, it is general. Investment income. We are taking our investment income where we are given our summary of investment income here. Investment income is comprised of, number one, interest received from government securities. Talk about interest. Interest received from government securities. We are given net of 2040. So 2040 being an interest from government security, that is to say, it is a non-qualifying interest. So therefore, withholding tax is 15%. Given our net, we must convert that to gross. So that is like saying the 2040 given there, 2040 given here, 2040. This is like 85%. For us, we want 100%. So what will we be having here? What will we be having there? So I'll just be taking now our value of 2040 multiplied by 100, we divide by 85. See? So this is what I need to disclose there. Interest from local, received from local banks. So interest received from local banks. Remember the concept of qualifying and qualifying. That is very important. And I told you that you never miss that. That one will always be there. It will be like a ghost on us. Where in this case, I'm also given net. So this is a non-qualifying interest as well. Withholding tax is 15%, which is not a final tax. That's why you're adding it back. So 760,500 is the same as 85. So about 100%. The same case, we have 760,500 times 100 divided by 85. So 6,500. So this is what you're having. Dividends received from a Uganda company. So being dividends received from foreign investment, dividends from Uganda company. this is exempt dividends. Being exempt dividends, therefore, here we are having dash. Dividends received from a local company. Dividends received from a local company. This is qualifying where withholding tax, WHT is final. Withholding tax is final tax. Therefore, also on that, I won't consider it there. See? After that, these are what you are told. Unearned premiums is maintained at 80 and 50% of net premiums received for motor vehicle and fire insurance respectively. So let us determine if at all you are having, increase or decrease in these unearned premiums. So unearned premiums at start, unearned premiums, we compare this. For motor vehicle, you are told we are maintaining it at 80%. This is just a working somewhere. Motor vehicle, we are maintaining it at 80% of the net premiums. So it is equal sign times net premiums of motor vehicle. Whereas for fire is 50%. Of fire. Point 5 times fire. So this is what we're having at end of the period. And what about start? At start of the period, an earned premium we had 4.8 for motor vehicle. See, we're just taking the figures that you're given here directly. And at end, we had 2.5. So what is happening? For both, we're having an increase. An increase in an earned premium. Therefore, being an increase in an earned premium, we are going to consider it as what? We are going to consider that, of course, as a form of expense, which we are going to deduct it. Below here, we'll be having, so this case, if at all you could be having a decrease, decrease in provision for unexpired risks or an earned premium, then we could have considered it at this point. But this time round, you've clearly seen it was an increase. So we leave it dash. Another item here. Investment income, we've done that analysis. Insurance premiums paid, unearned claims outstanding, legal costs, sundry, provision for bad debts and doubtful debts, management expenses, investment premiums returned. So no any other item. Consider our incomes.
Excuse mwalimu kidogo.
Yes, Rema.
I was lost a bit. Just asking, how did you get the 3.8 for the general insurance for the unearned premium?
You're told here. No, two. An earned
yes.
premium is maintained at 80% and 50% of the net premiums received for motor vehicle and fire insurance, respectively, right? So
Yes.
the 80%,
Mm-hmm.
80% of what? 80% of this should give us this was net
80%
premium.
of net premium.
So you're supposed to, yeah, at end, so you're having at end it is 80%. You've not taken the percentage. Let me
No, I was
check.
asking the 80% of
Oh,
what?
this is 80%. 80% we should have, this is 0.8. So this is 30-40. 80% of 3.8.
Oh.
So you take 80% of net premium for motor vehicle is 3.8, right? So
Net
you
premium,
take,
after the calculation there.
yes, after this calculation, right?
Oh,
You see, we had
okay.
3.8.
Yeah. I was lost
so
there, so I was.
Okay, so you take 80% of that, and for fire, it was 50% of that. Is that okay?
Okay.
Okay, great. And you compare with what you are given here. You see, like, check an earned premium at start 4.8, at end 2.5. So if at all you can look at both, we had an increase, and therefore being an increase is going to be taken as what? As an expense. Okay, great. So after that, I'm not seeing any other incomes. So we consider that. And all that. That. So because all these are didn't have, we're taking the total value, So once we have that, we determine our allowable expenses. Gross income. Consider allowable expenses. Increase in provision for unearned premiums, where these are what you're having. The first bit, of course, is an increase of that minus that. These are actually, these are decrease, right? These are decrease. Remember, like for me, I took the opposite. At start, these are what you're having. It's like saying, let me have this. This is what you're having. This is what you're having. At start, I'm having 4.8. This one, I'm having 2.5. At the end, determining the provision that you're given of 50 and 80, this is what you're having. So ideally, actually, it is a decrease. It is a decrease. It is a decrease. It is a decrease. It is a decrease for both. It is a decrease for both. So here, I'll just come and have a decrease for both. Sorry for that overlooked. So I'm having 760 here. Is a decrease for both. Kindly just amend it. 1075 is a decrease for both. it is a decrease for both, so that we are having summation of that, that plus that. It is a decrease because you compare at start and at the end. So kindly amend that. So here, in this case, we don't have that. Come and consider our additional information first. Claims. So we work out for claims. We work out for claims. We work out for claims. So our claims, what will we be having here? For claims. Claims for the year. Paid. We'll talk of the claims paid. Claims paid for these two businesses. Claims paid 2770 and 2110. Uh-huh. 2110. Claims outstanding as at the beginning of the period, where we are told claims outstanding as at the beginning, I'm having 1.1 and 840. So remember the format here. This is what you're taking. This is exactly what you're taking here. This is exactly what you're taking. Let me have it here. So this is what you're taking. This is what we are considering. Claims at the end, we're having 750 and 480. 750,000 and 480,000. Claims at the beginning of the period. Claims at start, 1,100 and 840. 1,100, 840. 1,100, 840. This one will less. So that as of the end of the period, these will be our claims for the year now. Consider another expense. An earned premium we've considered. Investment allowances have been agreed with the commissioner at 1.2 for the year ended at 1st December. So in this case, you're having investment allowances. Investment allowances. Remember this one, you're taking out the total, yeah? So investment allowances, this one was supposed to be here. Summation of this. To give us summation like that. So we're looking at investment allowances. The total value we are given here is 1.2. So I'm going to have it in our column total, 1.2. Fees paid to investment managers amounted to 750,000. So management fees. We're given management fees of 750,000. Done with additional info. We embark on this case here. Starting from top, all this we've considered. I'm having commission ceded. Commission ceded. We didn't take commission ceded here in our incomes. So you can just add it somewhere. Commission ceded. Commission ceded being part of our income. Yeah, these are commission ceded. These were 700. I'm not sure why we didn't took that. 700 and commission ceded 700 and 300. 700, 300. Of course, total there. Commission accepted being our expense. Commission accepted. Commission accepted. Commission accepted. We are given a value of 600 and 200. So 600,000. 200,000. Total. We've considered the claims paid, legal cost, on claims, legal cost on claims to 80 and 130, to 80,000, 130,000. That is legal costs. Sundry expenses on motor vehicle claims. Sundry expenses on motor vehicle claims. 220,000 on motor vehicle only. Provision, we aren't told anything in relation to that, and therefore we mention at any given point when the examiner is silent, we'll always assume it to be basically what? General, not unless otherwise you're told we're going to take that as our general provision. And general provision is non-allowable expenses. Management expenses here. Management expenses, you're given 450 and 380. Make sure that this time round you've taken everything. Please pay that on what you considered. For investment manager. I think we've considered everything. Sundry receivables, that remember that is balance sheet item. Directors' fees, have we considered directors' fees? Directors' fees, we take directors' fees. Directors' fees here amounted to 495,000. $495,000. That was just in total. I don't think if there's another thing that you've left out. But all, of course, you'll just confirm and check. So that as at the end of the day, our total expenses for the period, as at the end of the day, our total expenses for the period, these are what we should be having. Total expenses for the period. So confidently, we can come and talk of our taxable income. Taxable income, where we will take, of course, our value of gross income, we less our expenses there. To give us that. To give us that value, or the values that you're having there. So once you've considered all that, of course, you're asked to determine the tax payable. Tax payable here. Tax payable. Our tax payable, you should have the following. Gross tax payable. Which it is from our income there total. So you should be having this times 30%. with less withholding tax reliefs. Remember, there are incomes that we've earned which were subjected to our tax earlier on. So we need to give that a relief, and such, these are what we identified. These are the incomes that we identified. So like all these items, we need to take withholding tax of 15%. So WHT, 15%. 15%. 15%. We should be having that times that. These are withholding tax, which has to be deducted from our gross income. So we're having our net tax payable, net tax payable. I should be having our gross minus our withholding taxes. Remember, why are we deducting them here? We are deducting them because these taxes have already been submitted on our behalf in advance. And that's why we mentioned that withholding tax for non-qualifying items that includes both interest and dividends, they are not final. They are not final because these incomes are going to be aggregated with other incomes and taxed further. So that's the reason why you'll find that at this point, for me to determine the 4.9, the incomes of interest in government, from government securities, and interest from local banks was included here. And we tax it at 30%. So there's a percentage of this income that had already been submitted on behalf of us to the authority. So that's why we have to give a relief, deducting whatever that was already submitted in advance on our behalf. And that's why we have to net off that value. We have to net off that value. So that is in terms of general insurance. This is in terms of general insurance, a very interesting area. In terms of general insurance. Remember, we say that looking at insurance business, our focus will be taken into two forms of business: life insurance business and general insurance business. So what we have looked at right now was general insurance business. So you can have a concept of life insurance business, then we do a question with both life and general. Let us consider life insurance business, and when we do a question, we are going to do for both, so that at least the concept should sink in very well. The concept should sink in very well. So we have to do that right now. We can take a 5 minutes break. We can take a 5 minutes break. Okay, so I think that break is enough. So looking at this second part of insurance company, which is a life insurance, you'll find that it is an interesting area because it is not taxed like the businesses that we know, more so when determining the taxable income. It is a form of a unique scenario because there are some items that we will be required to consider here. So looking at the life insurance business, looking at the life insurance business, you're seeing that this is quite unique because for us to determine our income, that is talk of our taxable income, we will consider the following. That is, number one, we will talk of the amount transferred from the life fund. Amount transferred is our number one. We are talking about amount transferred from the life fund. Amount transferred from the life fund. This is as recommended, of course, by an actuary for the benefit of policyholders. For the benefit of policyholders. Number two, any other amount transferred any other amount transferred for the benefit of our policyholders. And finally, number three, talk of 30% of management, 30% of management and commission expense that is in excess of the amount prescribed by the Insurance Act. By the Insurance Act. So you'll find that at this point, like the other businesses where, like the other form of businesses or even insurance company where we are considering our amounts in terms of the taxable incomes and the rest, where we are talking of maybe gross premium or talk about other taxable incomes. No, on this case, we'll be looking at it in this form. And my attention or our attention should be drawn in this note number 3. Our attention should be drawn in this note number 3, where we are talking of 30% of management and commission expenses that is in excess of the amount prescribed by the Insurance Act. So how will you determine this amount that is prescribed by the Insurance Act? To determine this amount, you'll find that it is always based on the premium that the company is earning. It is always based on the premium that the company is earning. So at this point, we'll be talking of this premium scale rate. This is based on this premium scale rate. And this premium scale rate will not be given in your exams. It will be upon you to always understand it clearly. So we'll be looking at it in this context. That is a scale of premium scale of 1 to 5 million. $1 to $5 million. Talk about 5 million one to 12.5. Talk about 12 1 to 20 million. $20 million to basically 30 million. Then excess of 30 million. See? So looking at this scale rate, you'll find that these are the percentages that we'll be talking about. The first bracket subject to 25%. The second bracket subject to 22.5%. The third bracket subject to 20%. The fourth bracket subject to 17.5%. And the third bracket subject to 15%. Where this is to say, my good students, that when we are talking of this percentage, it is important to know that, for example, a company earning a premium of 0 to 5 million, then the amount of excess or the amount of management, maximum management, and commission expense that they are supposed to pay. Here, you'll find that it will be, of course, my 5 million, the difference, that is 5 million. We'll get that times the 25%. The difference here is 12.5 minus 5 million to give us 7.5. The difference here should give us again, that is, so this is 12.5. So this is again 7.5. Whereas this is 30 million, not 30, but 10 million. So interpreting this scale is the first bit, I'll be having that times that. So a company earning a premium of up to 5 million, the maximum management and commission that they're supposed to pay is how much? 12.5, or rather 12.50. The company earning a premium of 12.5 million max, they are supposed to pay, of course, 7.5 times 2.5. We take the cumulative. So cumulative, I should be having 1250 plus that. So a company earning a premium of 12.5 million. the maximum management and commission fees that they are supposed to pay is 29,37,500. What about the other one? Should be having that times that to give us cumulative. A company earning a premium of up to 20 million. The maximum management and commission fees that they are supposed to pay is this much. Then lastly, talk about, not lastly, but up to 30 million. So I'll be having that times that. So we take the cumulative. So that is to say, a company that is earning a premium of up to 30 million, the maximum management and commission fees that they are supposed to pay is this much. So that on this case, we can take excess. Any amount excess of 30 million should be 15%, assuming I'm having a company with an annual premium of, say, like 80 million. So if this company is earning an annual premium of 80 million, we can agree that the maximum commission and management that they're supposed to pay, I'll be having therefore excess of 30, that should be 80 minus 30 million to give us our value here, which would be 50. So I'll be taking now 50 times the excess, that is 15, so that the cumulative value I should be talking of 13,687. So a company with an annual premium of 80 million, they are supposed to pay a maximum management and commission fees of up to 13,687. What if this company, the company paid management fees of 10 million, or rather of 15 million, and commission fee, commission expense of 5 million. We are looking at it in this context, whereby a company with an annual premium of 80, and this company paid management fees of 15 and commission expense for 5 million. So on this case, we can agree that the excess, remember the prescribed commission is supposed to be 13,687,500. For them, they paid actual was 15 plus 5 to give us 20. So therefore, the 30% in 03, the one that Mwalimu is talking about here, therefore, in this case, I'll be having 20 minus this. So the difference, I get 30%. So I'll be having 30% of this should be amongst our taxable income. Should be amongst our taxable income. Say, should be amongst our taxable income. So this is what note 3 basically is stating to us. So most important is this scale rate. This scale rate here is very important. The scale rate here is very important. This will be our guide. This will be our guide. This scale rate is very, very important. That scale rate is very, very important. That will be our guide. That should always be our guide in everything that we will be doing. That should be our guide. So on this, I think I'll give you a work to do. Then you will compare that in our next class. Actually, once you're through with insurance, the rest of the things will be like you just see, like you'll be clearing a concept, like 2 or 3 concepts within one session. Because bank was among the longest bit. Insurance also is quite long. Talk about after this, the other bit, the other things you'll find that we'll be clearing them within like one session. We'll be clearing like 2 concepts or 3 concepts in one. And they'll just be very, very easy. And that one you can attest with Mwalimu as you progress. So in this case, I'll want you to attempt this question, where in the event that you're given a combination of both insurance, that is general and life insurance, how would you go about it? This question here, let me check it out. I want you guys to attempt this question. December 2021. December 2021. Remember, the allowable expense will just be the same as the rest. Check December 2021. December 2021, question number 2B. December 2021, question number 2B. I want you guys to analyze that question. So that when you meet next time, we are going to clear this question and then introduce another concept. So next class, the target is to check the concept of shortfall distribution. We can also look at our DTA. Then I think next class you can do 3 concepts: shortfall, DTA, and capital gain tax. We can do the 3 concepts basically in our next class. So next class you can do the 3 concepts. So by then, if at all you manage to do that, you'll find that the larger remaining bit will be petroleum, in C. That one can be done. Actually, you can do another 3 more concepts: petroleum, C, and contract at the same time. If at all you manage to clear those, you'll find that there won't be a computation, then will have a remain with VAT only. That is, even if you take a sample of your past paper, you'll find that those are the main computation areas. The rest are literally theory. So if at all you can manage that, that is to say goodwilling with the same pace, goodwilling by 23rd March, I think we'll have cleared all the computation. God willing, by 23rd March, but with the same pace, we'll have cleared all the computation. Because if at all we can introduce a bit of whatever that we'll be doing in next session, then on 9th we do some bits of that. 16th and 23rd we'll be clearing actually majority of this computation. So we'll have only remained with the theory as you're doing our revisions. So to that point, you guys, unless there's a question, I want you to attempt that question. Then we see. I remember there was some document that I was supposed to share. Let me share even before we close this class. That is let me have this basic concept. Let me share this in the group right now. Okay, so you guys basically make sure that at least you've attempted that. I'm also going to share this Excel so that you have it. So to that point, you have a good night, and let's meet in our next session. Bye-bye.